All right, so let's start off by saying that the war in Iran didn't cause higher oil prices. Hello everyone. Today's question comes from Parker, who recently wrote to us saying that he'd read our January white paper on oil, but was wondering if the war in Iran and the recent increase in oil prices has gone and changed our view. Parker, thanks for bringing up this topic. It's a question that really goes to the heart of how we assess and adjust to new information. I think as value investors, we're used to buying unloved stocks and waiting sometimes an awfully long time for the market to recognize and see what we see. What's unusual for us in this case is that we've seen a catalyst come along to prove us right almost immediately. All right, so let's start off by saying that the war in Iran didn't cause higher oil prices. Back in January, we argued that oil prices needed to rise based on the fundamentals of demand and supply. The war is a catalyst that simply brought the existing problems into sharp focus for the markets. So how do we analyze commodities? Well, first off, we ask ourselves 4 questions. Firstly, is demand strong and growing? Secondly, can supply keep up? Thirdly, are there any substitutes or new supply sources? And then fourthly, what's the cost of production relative to the current prices in the market? In our experience, when demand outstrips supply and when substitutes are limited and production costs exceed spot prices, it's usually a pretty good sign that prices are about to move materially higher. So how does oil stack up today? Let's start with demand. The US Energy Information Administration reported just last year that demand had reached 104 million per day. OPEC forecasts demand to grow by 20% by 2050, while our own CSIRO estimates suggest that local growth is likely at 75%. But many of those forecasts likely assume that demand will be materially reduced from renewables and the move to net zero. And I suppose that's a reasonable assumption, but it may be underestimating just how embedded hydrocarbons are in the global economy. Take electric vehicles, for instance, which are certainly reducing the demand on oil for passenger cars. But passenger cars only represent and account for about 15% of total oil demand. The vast majority of oil use actually comes from heavy transport, aviation fuel, fertilizers and plastics, where alternatives are very, very limited. And if the transition to renewable proves slower or more difficult than expected, well then we may be significantly underestimating what future demand for oil really looks like. All right, so there's demand. What about supply? We've discussed before that there have been years of chronic underinvestment in traditional energy. Lower prices have made projects less profitable, and social and political pressure have made financing, in some cases, almost impossible. So even if current geopolitical tensions shift priorities, new supply takes time, years, and requires substantial capital. I recently read estimates that suggested the industry needs to spend over $500 billion annually just to maintain the current production levels. Fine, so we've got growing demand, tick number 1. We've got hamstrung supply, tick number 2. What about prices and alternatives? Well, when we wrote our paper in January, oil was trading at around about $50 per barrel, well below our estimation of global production costs, which is around about $60. Today, prices are closer to $100. That's certainly progress, but the underlying supply challenges still exist. We've seen how fragile energy security can be. In Australia, for example, fuel reserves are well below the 90 days recommended, and that was even before the war. Globally, supply chain disruptions have also exposed lots of vulnerabilities, especially in countries that are dependent on energy imports, countries like China and India. Now, historically, US shale has acted as a flexible source of supply, but even that has constraints. In recent years, we've seen production declines, significant production declines. At the same time, we've seen high quality reserves being depleted much faster than expected. So ultimately, something has to give. And we think that's prices, higher prices. Higher prices will eventually incentivize new supply and restore balance. But as we said, that process takes time. And who knows how high prices can go? No one knows for sure. We actually think that a range of between $80 and $120 per barrel is probably plausible. A little uncomfortable maybe, but not high enough to significantly destroy demand. So what does that mean from an investment perspective? Energy has become a very small part of equity markets. If you look at the US S&P 500, energy has fallen from around about 12% of the index to under 3%. On the ASX, it's very similar, having fallen to about 3.6%. And despite all the strong tailwinds, many energy companies are still trading at valuations that seem to ignore the potential for sustained future free cash flow. Last year we noted this, and between November and January, we invested in a number of Australian names like Santos, Beach Energy and Karoon, all on single-digit PE multiples. The market seemed to be almost ignoring current earnings, let alone ascribing anything to future growth. But if recent events have shown us anything, it's that the world is more reliant on oil than many people might have assumed. It's actually foundational across every economy and is the most widely used commodity globally. And while it's difficult to predict exact prices or the direction of earnings, we think the market is starting to reassess the importance of traditional energy. And that could support higher prices and valuations going forward. So with all that said, what are my two key takeaways? I think number one, headlines, they change every day. Our job as investors is to keep our eyes and our focus on the fundamental truths that don't change. Number two, when there is a persistent disconnect in valuations, a catalyst, sometimes a drastic one, will eventually restore the equilibrium. In this case, the war in Iran looks to be that catalyst. Thanks again, Parker. That was a great question. And to everyone else watching, thanks for staying with us to the end. If you have a question for a future video, please feel free to reach out to us via phone, email, or in the comment section below. Bye for now.